Hello everyone and welcome to the second lesson of this workshop. The first lesson was more informational as we try to introduce you to commodities. I am sure you have a good idea of what commodities are by now. And today, let's move to the more practical stuff. We will show you how commodities actually trade on a commodity exchange. It is going to be a longer lesson, but on the other hand, you will learn a lot of new information. Before we start, I have to remind you, this video is not investment advice. If any financial instruments like futures, spreads, ETFs, options or others are mentioned anywhere in this video, it's always just for educational purposes. We rarely know what commodities are, but today we will be more specific. A commodity is goods which you can standardize. You can set its price per unit of its weight or volume. We use price units for this, and we will show you some examples in a few moments. The second crucial point is that commodity quality differs very little across producers. Corn from farmer A is very similar to corn from farmer B. This doesn't apply to cell phones, for example. A cell phone from maker A is very different from the cell phone from maker B. They can differ in features, screen size, design, and many other parameters. The price of a cell phone can also vary widely. Therefore, the cell phone is not a commodity. But if someone would give you one bucket of corn from farmer A and right next to it another bucket with corn from farmer B, they would look basically the same and command the same price. Therefore, corn is a commodity. And now, let's show some examples of commodity price units. Corn is traded in US cents per bushel. Hogs trade in US cents per pound. Cocoa is traded in US dollars per ton. Coffee is traded in US cents for a pound, etc. For example, you see a chart showing that corn price is 400 cents. It means one bushel of corn costs 400 US cents, basically $4. Let's move on to the question, where are commodities traded? Commodities are traded on commodity exchanges. We have some examples here: CME, NIMEX, ICE, NYBOT, CBOT, but in fact, there are mainly historical venues. Nowadays, most of these US exchanges are owned either by the CME Group or Intercontinental Exchange. But that's not important right now. The essential thing is that commodity trading is centralized and strictly regulated. Let's talk about it in detail. Centralization means that the orders from the traders are cleared in one place. These days, this place is actually virtual, as the trading is done electronically. Regulation is also critical. Trading on commodity exchanges is regulated by a federal or other government authority with a clearly defined set of rules. Everyone must follow these rules to participate in the market. This applies mainly to clearinghouses, brokers, market makers, and other institutions who create the market. But we should be aware of the rules too as we trade through these institutions. There would be no trust between counterparties without this system. We can be confident that our counterparty will abide by the contract terms if we open a position. And that is a huge difference from, for example, currency trading on Forex. The majority of these Forex brokers are actually creating their own market with their own rules and no oversight. But in that case, how can you be sure the trading is fair for all attendants and that your money is safe? Commodity trading is much safer in this regard as there are much stricter regulatory requirements for commodity brokers. But of course, this only applies to brokers trading real commodities, which means futures contracts and not unregulated garbage like CFDs. We will talk about the futures contract in a moment. As I already mentioned, the exchange is a virtual place today as trading is done electronically. But it was different in the past. People met in person at an actual exchange. The trading was performed in the so-called pit, where traders screamed orders at each other and used weird hand gestures. It was very intense, and I guess you probably saw that in the movie. The picture on the right shows how it's done today. It's just a bunch of servers aggregating orders from traders all around the world. The advantage is that we do not have to go anywhere. We can comfortably stay at home, and all we need is a computer with an internet connection. The trading has also become much cheaper as the broker fees have dropped significantly. And now let's move to the topic of this lesson. How are the commodities traded? Well, commodities are traded using the so-called futures contracts. Each contract is an agreement between buyer and seller. The seller agrees to deliver a certain amount of commodity at a predetermined price, and the buyer is obliged to take this commodity and pay it in full upon delivery. But don't worry, you won't end up with rail cars of corn, as we will explain in a moment. An important detail is that each contract has a specific expiration date in the future when it ceases trading on the exchange and the delivery process starts. There are several futures contracts with different expiration dates trading at a given time for each commodity. So, if you would decide to trade corn, you can choose from many futures contracts with various expiration dates. As the expiration date comes, the settlement process starts. It can be either physical, when an actual commodity is exchanged, or financial, when the buyer and seller settle in cash instead. But like I said, normally it won't concern us, but you should just be aware of this process. Let's make two examples for buying and selling a futures contract. When we buy a futures contract, we undertake ourselves to buy and physically take over the commodity at a specified future date for the prearranged price. For example, the current price of the futures contract that we decide to buy on the exchange is 400 cents per bushel. So we have to take delivery of the corn at some future date. What is the utility here? Well, we know in advance at what price we will get that corn. It will be exactly 400 cents we paid when we bought the contract, no matter what the market price will be at the time of delivery. Moreover, you would have to make just a small deposit to secure the price of a large amount of corn given the size of the contract. If it sounds too abstract, I will give you an example from daily life. Let's say you want to buy a new car, but the model you wish is not in stock anywhere. You must order it and wait 3 months until the car factory manufactures it. So you sign a contract with a car dealership with a clearly stated price you will pay when they hand the car over to you. The price of the car is $30,000. The contract also stipulates that you make a deposit of $2,000. This is a common practice in every car dealership. In fact, you just signed a futures contract. The margin is $2,000, the contract size is $30,000, and the expiration date is 3 months from now. The dealership sold the futures contract and is obliged to deliver you the car 3 months from now. And you bought the contract and must take over the car 3 months from now and pay the remaining $28,000 upon the delivery of the car. This futures contract is helpful to you in 2 ways. First, you can be sure to have a car 3 months from now and can easily plan a family vacation 4 months from now. The second benefit is that you practically locked the price of the car in advance. Imagine a situation when the car manufacturer decides to increase the price of all new cars by $5,000 due to unexpectedly strong demand and limited manufacturing capacities. So, when you take delivery of the car, the same model would cost $35,000 for new buyers. Yet, it would cost you just $30,000 because you have the price clearly stated in the contract. These $5,000 are your profit. That's great, isn't it? However, it also works the other way around. If the car price goes down to $26,000, for example, due to an economic recession that's just starting, you would have to pay the agreed price of $30,000 no matter what. Therefore, you would lose $4,000 on the contract. Now, back to the markets. The commodity futures contracts work exactly as in our real-life example, with 3 exceptions. The first one is that you can take delivery of the car sooner if the car factory manufactures faster than expected. That's not possible on the exchange. The expiration date is clearly set for the futures contract, and the delivery process cannot start sooner. The second difference is the settlement process, which can be either physical or financial for commodity futures. The physical settlement is precisely the same as in our car example. Basically, you must take off the physical commodity or the car in our example. However, the financial settlement means no physical commodity would change hands. The seller just pays the buyer the difference between the contract price and the market price at the delivery date. Or the buyer pays the seller depending on where the market price is and therefore which counterpart makes a profit and which incurs a loss. That would not be possible with the car contract. The third and most important difference is that in reality, you don't have to take delivery of any physical commodity even if the contract has a physical settlement. You can sell the contract to someone else who would take over the obligations associated with it and settle a profit or loss with you. In our example, that would mean you suddenly realize you do not need a new car anymore sometime after signing the contract. So you will find someone else who actually needs that particular car and transfer the contract to him so that he's now entitled to receive the car from the dealership. If the price is this particular car went up on the market, since you signed the contract, the other guy will pay you the difference between the market price and the price agreed in the contract. If it went down, you would pay him. And finally, the car dealership would return you the deposit. Of course, you can't do this with car contracts, but it is normal practice with futures contracts. You can sell them or buy them back well before the expiration and avoid dealing with the settlement. In fact, that's what all the speculators do. They are not interested in the physical commodity itself. They want to profit from the price movement by buying and selling futures contracts. In fact, most brokers didn't allow physical settlements. We have to get rid of the contract well before expiration. If we wouldn't do that, the broker would automatically close the position. Let's summarize other important facts you should know by now. Futures contracts for each commodity are defined by a set of specifications published by the exchange. It is, for example, the contract size, price units, and the like. And what is important to realize is that the price of futures contracts changes based on the current situation on the market. Again, let's take a look at a concrete example. Let's say that we are interested in trading corn and it is January. So we choose a futures contract with a December expiration date. It means the contract price will be changing until December when it ceases to trade. We can buy or sell the contract as we want until then. As the expiration of the contract approaches, we have to get rid of it. In such a case, the settlement does not affect us. And that is understandable. Our goal is to make money, not to deal with a physical commodity. Now it's time to explain what ticker is. It would be impractical to write down the entire contract specification whenever we want to trade it or just tell someone what we bought or sold. In fact, we need just 3 pieces of information to ambiguously identify a futures contract. It is the commodity, expiration year, and expiration month. So the complete ticker is made out of these 3 things, just abbreviated to make it short. Let's explain it in detail. The first part is the commodity symbol, typically 1 or 2 and rarely 3 letters. The second part is 1 letter, which stands for the expiration month. And the third part is the expiration year, typically abbreviated to the last 2 numbers for simplicity. We have a few examples here. The first one is the GCQ22 futures contract. GC is a symbol for gold, Q letter stands for August expiration month, and 22 stands for the year 2022. Another one is the ZCH20 contract. ZC is the symbol for corn, H letter stands for March, so the contract expires on March 2020. And finally, the CLZ17 contract. CL is crude oil symbol, Z letter stands for December, and 17 for 2017. Maybe you wonder where you will find the symbols for commodities and expiration months letters. The month codes are easy to learn, it's just 12 letters, and the commodity symbols can be found on the exchange website. You can also see the full list of commodities and available futures contracts in our analytical software, the Spreadcharts app. We will talk about it also later. Now let's summarize what we know. You learn what commodities are, where they trade, and what futures contracts are. It is a lot of information, so if you need a pause, just stop the video and think it through. Otherwise, let's move on and explain the futures contracts further. Our goal in trading is to achieve profits and minimize losses as much as possible. But how is the profit or loss calculated? In order to answer this question, we need to understand contract size. Of course, it is listed in the contract specifications. But why is it important to us? This is really crucial to understand, so I will go step by step. We know the price unit for corn is cents per bushel. A bushel is a unit of volume and it is approximately 35 liters. You can imagine it as 2 buckets of corn. And when the current price of corn on the exchange is 400 cents, it means that these 2 buckets of corn cost 400 US cents. This is the price we see on the chart. But we do not trade just 2 bushels of corn. The futures contract has a specific size and it's not just 1 bushel. For corn, it is 5,000 bushels. What does it mean? If we buy or sell 1 corn futures contract, we actually control 10,000 buckets of corn. That's a wagon full of corn. The point is that futures contracts are huge. That leads us to another important term, which is the value of a future contract. The current price of some corn futures contract is 400 cents per bushel, or simply $4 for 2 buckets. But that doesn't mean that value of the contract is also $4. Do not forget about the contract size. When we buy that contract, we do not hold just 1 bushel. As we said, we now hold 5,000 bushels of corn. The calculation of the contract value is simple. Just multiply the current price by the contract size. We said the price is $4 and multiplying it by 5,000 bushels gives us 20,000 US dollars. That's quite a lot of money, isn't it? Definitely more than $4. Now you understand why the futures contracts are huge. If we start to talk in more professional language, futures are derivatives. But feel free to forget this word if it sounds too strange or scary. It just means that the value of the futures is not equal to the commodity's price, but it is based on it. Futures value is based on commodity price because the futures contract has a certain size. And that value is enormous, as you saw. We will show you more examples later in this lesson. The most important information here is that our profits and losses are not calculated from the change in contract's price, but from the change in its value. Let's demonstrate it in the following example. Imagine that we buy one stock, but stocks are not derivatives. So if the stock price goes up by 1 cent, our profit is exactly 1 cent. However, if we buy a corn futures contract and its price goes up by 1 cent, our profit is not just 1 cent. It is 1 cent multiplied by 5,000 bushels, because we hold 5,000 bushels of corn, and that equals $50. So our profit is $50. Now you probably think it is quite complicated to trade futures, having to remember the price unit and the contract size to calculate profit or loss. Don't worry, there is a shortcut which makes it somewhat easier. In practice, traders use the so-called point value to calculate their profit or loss. 1 point on a chart represents the smallest whole number price increment. Maybe it sounds too complicated, but in reality it isn't. 1 point represents a change in price by 1.0 on the chart. So when the commodity is traded in cents, 1 point equals 1 cent. And if the price of the corn goes up by 1 cent, it increases by 1 point. When the commodity is traded in dollars, 1 point is $1. And finally, the point value is the change in the value of the contract if the price changes by 1 point. In other words, our profits or loss if the price moves by 1 point on the chart. Corn, for example, has a point value of $50. This will make the calculation of the profit or loss much easier. Here is a concrete example. When we buy a corn futures contract for 400 cents per bushel and sell the contract for 430 cents, the difference is 30 points or 30 cents. And if we know that the value point for corn is $50, it is straightforward to calculate our profit. 30 points multiplied by $50 equals $1,500. Once again, if you need to slow down a bit, pause the video and replay it. Make sure everything is clear because this was another crucial thing to understand. If you are ready and everything is clear, let's move on to talk about the basics of trading. We will explain what a long and short position is. Let's start with a long position. We intentionally marked it in green. When we want to open a long position, we are about to buy a futures contract because we speculate on the growth of the price. We think that some commodity is cheap, so we buy a futures contract and expect its price to rise. We will later sell it at a higher price if the market moves as expected. The difference between these prices is our profit. Conversely, we can also open a short position, basically selling a futures contract. We would do so when we expect the price to fall. For a better perspective, let me show you that on a chart. I will start with a long position. You are looking at the corn price chart, specifically December 2019 corn, or ZCZ19. This contract expired in December 2019. And now, imagine we want to buy corn at 390 cents because we think its price will go up. We open a long position. In other words, we buy the contract. After the price goes up, we close this long position and sell the contract back at 440 cents. How to calculate our profit? It is this green arrow that represents the difference between these prices. Minus 390 cents, minus because we bought the contract, plus 440 cents because we sold it. The difference is 50 cents or 50 points, and we know that the point value for corn is $50. Multiply the number of points by the point value and you get your profit, $2,500. You can clearly see why explaining all the terms in this lesson was so important. And here is the short position. It is a speculation on the decline of a commodity price. Opening a short position means selling a futures contract on the exchange. For example, we decide to open a short position at 450 cents. So we sell a contract at this price, of course assuming there will be a buyer matching our order. We think that the com price will fall, and as you can see in the chart, that's what actually happened. We decide to close the position at 400 cents. We do so by buying the contract to nullify the position. Profit calculation goes like this. Plus 450 cents minus 400 cents equals 50 cents or 50 points. The point value is $50, so 50 points multiplied by $50 is $2,500. That's our profit. By the way, all these charts you saw are from the Spreadcharts app. We will give you detailed instructions in the next lesson. It offers many different tools beside price chart to analyze the market from every angle. For now, please stay focused on the theoretical part. We will get to the practice very soon. Now let's get back to the futures contract's value. It is essential to understand the follow-up things we will talk about now. Focus on the last column in this table. We have already explained the contract value for corn. This table shows more examples for various commodities. Some of them are really high, like gold, for example. At $1,230, the gold's contract value is $123,000. The contract value is not static and moves with the changing price of the contract. Keep in mind our profits and losses are calculated right from this contract value. And here comes a question, maybe you already have it on your mind. How can we afford to trade futures contracts with such an enormous value? Of course, most of us do not have so much money. We already touched on this topic during the introduction to futures contracts and our example with a car dealership. In order to hold a position with such enormous value, you have to make just a small deposit. This deposit is called margin. It is defined as the minimum amount of free money on your brokerage account to open precisely one contract. This deposit acts as a protection for the broker if the trade moves quickly in the wrong direction. Keep in mind, he allows you to control contracts of huge value, and that's not without risks. You also need the so-called margin account at your broker to be able to trade futures. The size of the margin depends on the specific futures contract and commodity. After we exit the trade, the broker releases the margin and we get that money back. In this table, you can see contract values from the previous table together with margins. For example, corn has a contract value of $20,000 and the margin is $1,312. Gold's contract value is $123,000 and the margin is only $5,630. Of course, $5,630 is a lot, but if you compare it to the contract value, it looks tiny. This table was valid on 24th of May 2016, so please take this just informatively. The prices and therefore contract values are rounded. Moreover, the margins are probably also different now. Brokers can change margin over time due to high volatility or a material increase in the commodity price. Moreover, there are more types of margins. This one, for example, is the overnight initial margin, which is the most important. But let's not get into details as this is not the goal of this workshop. Once you are familiar with the fundamental stuff, you can find different types of margins on your broker's website. But for now, let's stick to our itinerary. So, why do we even talk about this? It is crucial to understand the inherent leverage in futures trading. We can just make a small deposit to hold a futures contract with a huge value. A picture is worth 1,000 words. Here is an example of our favorite corn. To manage the contract valued at $20,000, we need just $1,300 in our account. And that is great, right? Yes, it is great. This is the advantage of leverage. It allows you to trade large contracts with just a small amount of money. And the profits are calculated from the entire contract value, not just from the margin. This can multiply our profits. But, on the other hand, there are some serious risks in leverage trading. Loss is also calculated from the contract's value, which can be huge compared to our capital. Therefore, we can suffer catastrophic losses very quickly. But this is like many things in life. There are always positives and negatives. Fire can help us survive in the wilderness, but it can also burn us to death. Yet, we do not fear making fire for heat or cooking when we go camping. The key to suppressing the risk in leverage trading is to stick to a few elementary rules called risk management and never break them. Then, you do not have to be worried you will blow up your account. Instead, you can use the leverage in futures trading to your advantage. If you want to find more information about commodities you can trade, contract sizes, margin, etc., you can visit the websites of the two largest commodity exchanges in the world, the CME Group and Intercontinental Exchange. We have reached the end of this lesson, which was theoretical, full of basics, but very important. If anything was unclear, replay the corresponding passage again. In the next lesson, we will delve into more advanced stuff indispensable to understanding the commodity markets. Remember, you should never trade something you do not understand. Thank you for your attention and see you in the next lesson.